October, the U.S. economy slowed to near zero growth relative to the October PMIs. So, the chart I'm showing you is a monthly PMI chart. That's the PMI data comes from ISM. There's an alternate version of this data from SP Global that came down pretty close to the ISM version, and it's unusual to see them both on the same page on a given month, but they correlate quite well with one another. The reading for October was 50.2 versus 50.9 in September. The SP Global was near 50.2 versus a 52 in September. So what are we talking about with these PMIs? Well, basically, you can see on this PMI chart, I have a horizontal line at 50. If the PMI is above 50, manufacturing is growing or services are growing, depending on which indicator you're looking at. And you just use that as a guide for the economy. So if it's over 50, the economy is growing. And the higher it goes above 50, the faster the growth of the economy. Below 50, the economy is falling backwards. It's slipping. And in theory, around 45 and lower, the economy will be in a recession. Now, I use business cycles and apply it to stock market prices and commodities, but I also apply it to the economy, fundamental data, climate. At any rate, these business cycles suggest that in 2008, 2009, the juggler business cycle, and you can find that online, bottomed with a recession, end of recession. The PMI exploded, and that's normal behavior when it comes out of a recession. Then the PMI stalled with 50 is pretty much a floor, and it just stalled all the way to the 2018 to 21 time frame when it was time for that juggler business cycle to top out, and time for a once-a-decade sell signal in the stock market, and time for the economy to evolve into a recession. Well, in December, or in 2018, we were looking for top and decline, and in 2019, we said it's underway, but there were some issues along the way that the country didn't seem to want to follow the rest of the world into a recession. And right at the end of 2019 to the start of 2020, we did get a bounce, and there was some evidence that employment might have actually been starting to improve, the economy improve in the U.S., even though it was still deteriorating in the world. And then, wouldn't you know it, COVID showed up. And then we get the slam dunk to put it in recession territory for the PMIs, and we actually had the COVID recession. Okay, so the cycle repeated, even though the Federal Reserve and a few politicians were doing some things there to try to counter it. It's history repeated, but we had to use nature to help repeat the history. We as a people were trying to fight with the cycle, and we didn't win. We got the recession. Now, we then get the explosion out of the recession. Again, typical behavior, but compared all the way back to 2003, the economy did grow at a faster pace. We really stepped on the gas. We printed a lot of money. We pumped the economy. Now, in late 2021, I warned that during 2022, the PMI would come down, but we shouldn't go in a true recession, or that once-a-decade primary recession. It might be a secondary recession, but it might just be a slowdown in economy. Well, we've come back to near the 50 line, so below 50, the economy is moving backwards. I doubt it's going to 45. That's not the best forecast right now. It may dip below 50 here in the next few months, but the best forecast is it's going to bottom for a lesser important and shorter duration and lesser impact business cycle called the kitchen business cycle. Now, my definition is a little bit different than what you'll find online and in economics books, but it's for real. Now, in prices, I don't call it kitchen. I call it a 3 to 4 year cycle. I call it an LT3 model cycle in the stock market. And we've been bearish, the stock market, but we've been looking for a long-term bottom in the stock market now, okay? Now into early next year, and it may have occurred on October 13th. Now, for the PMIs, we said we would like to see it bottom no later in October, and here we got a nice drop in the PMIs down to about ready to dip into backing off an economy here. It may bottom now, but we can see spillover momentum, and it may not bottom early next year, which we think is the latest for long-term bottoms for the economy, long-term bottoms maybe for consumer sentiment, a variety of macroeconomic data, and for the stock market. And again, the stock market may have already bottomed. It may bottom ahead of the economy. So this is why we have a K here telling us to watch out for the kitchen cycle. We have a K to the upside in 2023. We think the PMIs improve in 2023 to maybe even into 2024, but would likely stay below 60. That would be normal behavior. You can see here in the last decade, it's spent a fair amount of time just in the 50s, and the economy actually grew to record high levels. The stock market rallied to record highs. So you do not need the PMI to continue to pound out high levels. That's meaningless. It doesn't work that way. It's stuck in a sideways range. So this is normal behavior for it to come down within a major long-term bull market for the stock market and growth for the economy that could last well into the end of this decade. This is a normal correction, and it will rebound some, but not go back to the high of 2021 unless we're really going to pump a lot of money and really boost economy, and I don't think the Fed's going to do that. I don't think anybody is going to really push in that direction. At any rate, yes, it looks ugly, it looks bearish, it looks negative, but it is time to turn this indicator up. And so we then take the PMIs and turn it into an annual chart so we can better see some of these long-term patterns, this juggler business cycle. So each one of these candles or bars is just showing you the open, high, low, and close of a year, the end of the year PMIs. And you can see we're on the low end for the year. It's looking ugly. It topped last year as it should have. It's come down as it should have. And it's due for a bottom now into sometime next year. And we put it under the microscope and we're thinking it's probably going to bottom no later than first quarter of next year. Don't know for sure. And the point is, it may have bottomed, maybe bottoming now or anytime into, say, the first quarter of next year. So this is just an interesting way to see these patterns. Each one of these J's tells you the decade growth and decade rise of inflation and a decade rise and drop in interest rates and the decade styled drop in the economy, the recession. So ideally, the PMIs are going to stay up towards 60 for the rest of this decade, and then they're going to drop sharply into recession territory. There may be some lesser important recessions along the way. There'll be corrections in the stock market. It's going to continue to fluctuate every day. But bottom line is, yes, this looks scary, but it's actually got a contrarian positive side to it, that by next year and the following year, the PMI should recover and the stock market should move higher and the economy should continue to grow to record size. This suggests we are going to beat inflation, and separate business psychoanalysis suggests that. It suggests interest rates are not going to rise by huge amounts for a very long time and hurt the economy. And separate analysis of interest rates suggests that. So we can use this PMI as a reverse modeling to tell us where the stock market and the various factors of our economy, things like inflation and interest rates, and then we can turn around and use this type of model analysis in those things by themselves and bring it back to see if it makes sense, a feedback loop. This next chart is when we take the PMIs and we simply say, if it's above 50, add it to the prior month. If it's below 50, subtract it. And then we convert it to an annual chart it out, and we can see the economy has basically been growing forever, at least since the 1930s, okay? But it's had some super cycle problems at times, specifically 2008, 2009. But other than that, it's been primarily these juggler cycles. And notice I put a J for each juggler business cycle bottom, and I put an R with it saying there was actually a recession then, and the Federal Reserve and NBER and others and other economists are in agreement there was recessions then. So that's our primary recession. But this takes away some of the month-to-month fluctuation. Maybe you want to call it noise. The model says there's no such thing as noise. But at any rate, what we have is growth, recession, growth, recession, growth, recession. Some work better than others, but notice how overall we've had economic growth. So we can scare ourselves too much relative to the stock market. But you do have to remember, the stock market can drop a considerable amount off of these once-a-decade sell signals, like 20 or 50%. And when, at the end of this decade, it may even be 60 or 70. But at any rate, we also get fantastic economic growth during the decade, even though there's scares, corrections, and problems, and even though the stock market can fall by a considerable amount, like 20-some% like it did this year, and that was in our parameters. Anyway, we can see that the indicator as of October, even though it backed off to near 50 for the PMI, we have to actually add that. And what it's saying is new record high for that indicator. We call it the econ indicator, and that implies that nominal GDP per capita and other types of GDP measurements are probably also at record highs. That implies our economy is record large, record value, size, however you want to look at it. At any rate, everything is on track, and we don't believe that we're looking at a destructive moment now into next year in terms of fighting the economy. And GDP just jumped to 2.6% for the third quarter versus minus GDP for the first half of the year, which is a definition for a recession. But it's a weird recession, and we don't even think it was in a recession, that the GDP indicator was off a bit. But to have it shoot up to 2.6%, and we were forecasting a recovery for the third quarter for GDP, backs us up on our thinking that PMI is eventually going to turn higher. We're going to be okay. We're going to survive this whole inflation story and these rising interest rates. Not saying we can't be off the mark a few more months here, but it's looking like we want to be optimistic for 2023 to 2024 for the U.S. economy. I'm Rich Pawson for criticalpointpod.com. Visit us, get on board. We got a nice bull market coming this decade, but we also got a sell signal that we want to be out of, because the stock market can drop 20 or 50, 60%. I think more like 45% at the end of this decade. Thank you. Past results are not necessarily indicative of future results.